Hey team, what is up? Welcome back to the Dentistry Invest podcast with returning and familiar face, my good friend Jon Doyle, IFA. Jon and I are going to be covering portfolio building 101 today. We're going to talk about how you can begin to take your first steps into investing, or if you're already there, how can you build your knowledge further so that you know that your strategy is optimized and you're getting the best result. Isn't that right, Jon?
It is, yeah, yeah. Quite
Lovely,
excited for this one.
lovely. Lovely, lovely. How have you been since we last spoke?
Pretty good, pretty good. I've done my first triathlon for the year, so that went okay, and had a nice time surfing in Wales as well. So it's been quite good. Yeah,
You did your first triathlon, the whole flipping thing.
of the year, yeah, yeah. Like so, I've got a few more proper ones later in the year. This was a little short sprint one, but it was good fun. It was good fun.
No, I'm just stunned because I know it. You'll be able to rhyme this off the top of your head, but I vaguely know this as someone who, as an athlete who's, well, an athlete might be a stretch, but as an individual, as a person who has never ever competed in a triathlon. All I know is that they're long, they're hard, and they require a lot of physical endurance. And how many
uh,
miles is it you run, and then how many you
See,
swim?
this one was a sprint triathlon.
Okay.
So it's only a 5K run at the end. It's like a 10-mile bike and a 400-meter swim. So it's a little diddy one. It was done in an hour and 5 minutes, hour and 10 minutes, like a little one. I've got a proper Olympic one later in the year. Yeah.
Respect,
Kind of a
respect, and
warm up.
fair play. And how much is the full thing, the full turkey?
Oh, full. I've never done an Ironman. I've never done one of those, but they're like, you run a marathon at the end, having already done like 160 or 180K on the bike and a
Yeah.
3 mile swim. I've done a half one, which was brutal enough. That was like 7 hours. That was a few years ago.
And that's what you're gonna do this year, the full thing.
No, I'm doing an Olympic one, which is what you'd see at the Olympics. So that's like a 1,500-meter swim, 45K bike, and a 10K run. So
That's still a solid effort. Hats off, mate. Fair play.
yeah, yeah.
Fair play. Anywho, we should probably talk about investing at some point today. So, so portfolio building from the ground up. Let's break this down really simple because there'll be a real diaspora of people listening to this
Mm,
podcast. Some people will have never invested because they don't really understand the point. Some people will be seasoned, hardcore veterans of the
yeah.
scene, and we're going to ensure that everybody's catered for in this podcast. Of course, let's start from the start, best place usually, and let's discuss why it's a good idea to think about investing if you haven't already dabbled.
Yeah, I think like the easiest place to do is think right back to sort of first principles of what is it we're doing when we're investing. We're basically making a decision that I don't want to spend this money today, but I want to spend it in the future, and I want it to be worth at least the same amount in the future in terms of purchasing power. And I used to have to spend a lot of time explaining inflation to people, but we kind of all get it a little bit now because we're seeing it week by week in the supermarket.
Well, this is it, right? You don't need to use these analogies anymore, which I used to use
Yeah,
to explain inflation. I used to say it's the rising tide. It's the
yeah,
rising. It's like global warming, right? The oceans are going to rise, right? So
yeah,
you got to beat them, right? That's
yeah,
what I used
yeah.
to say. But now you don't even need to go there. You just say go to Tesco's on Monday, go to
Yeah.
Tesco's on Friday, right? Inflation, boom.
Indeed, indeed. Yeah, and it's like I have a slide I show like new clients. I call it the beer and burgers index, and it's like the cost of a beer or a burger, like from the 1980s right through to more recently. And it was a good fun way of saying like this is what we're trying to do really, because we want to be able to buy beer and burgers in 20 years, 30 years time. But we can all think about what a Freddo cost when we were a kid, right? Or what a can of pop was. Although we
I,
shouldn't probably eat those things, we're
I,
talking a dentist here.
I saw Freddo's for 69p the other day on
Yeah, there
Facebook.
you go.
So that is 700%, And I know that not everything is went up 700%, but if Freddo's is our yardstick, there's a lot of people who are indignant, let's say that.
Yeah, yeah. And so when we're making the decision to not spend today, but want it for the future, whether that's to set our kids up financially, whether it's to retire, whether it's to be able to go on holidays in later life, or what, for whatever reason we're choosing not to spend this money today. Absolutely, job number one is to protect the purchasing power of this money. Inflation's our biggest enemy, absolute biggest enemy. So that's reason number one as to why we need to do something with our money. And cash, typically, your bank account has been a very, very poor protection against inflation. It's really underperformed it.
Yes,
So it's not protected. So we need to do something other than hold cash.
well, this is it, right? And if I look back on my journey, the real call to action for me was the day that I realized that actually you're not okay by doing nothing, right?
Mm-hmm.
Whereas previously my mindset was, oh, well, okay, well, at least if I don't do anything, I'm not risking it, right? Actually, you're risking everything by not doing anything,
Yeah,
unless you
yeah,
equip
yeah,
yourself with this knowledge, right? It's a total mindset flip. And I was like, wow, I actually have to actively educate myself on this so that
yeah.
that doesn't happen to me.
Well, if you go back to the Freddos, right? If you've if you've had a pound coin in your drawer of your, you know, your bedside drawer or whatever, 20 years ago, that was worth 10 Freddos. Now it's not even worth two.
Frightening stuff.
Yeah. So that's the whole thing we're looking to do, is put our pounds somewhere till they turn into multiple pounds, and we can buy as many, if not more, Freddos in the future, or
Lovely, jubbly.
Ferraris, or whatever we're doing.
Now
So
you're speaking my language. Okay, cool. So let's move on to the next step, which is for us to articulate the elevator, not pitch, but the elevator description, I suppose, of how one can begin to be able to appreciate their wealth.
yeah. So we would then say, well, we need to take this money, and instead of having cash or fiat currency, we need to buy assets. We need to buy things that either other people want or that have some form of utility. And so typically you're looking at buying companies. So investing in the stock market, you look at buying property. You're looking at lending money through buying bonds, either corporate bonds or government bonds, or you might be looking at what we would in the advisor world called alternative assets. You know, and everyone's got the friend who invests in watches or invests in whiskey or invests in various other things. You know, but we need to be looking to do something to put our money into a store of value. Okay.
Cool. And as an IFA, obviously we've got the steady Eddie route, you know, we've got the things that people typically use to appreciate their wealth, and we've got the more outside stuff, the
Yeah.
stuff that's more unusual or exotic. Yeah.
Mm, mm.
So what would you tend to advise is a great place to start for most people of that mix of
Yeah.
assets?
So my whole approach to investing is to be, where possible, evidence based. And so the most reliable and repeatable source of wealth growth and protection that we've got evidence for is the stock market. There's over 100 years worth of data that we can look at for the stock market, and it can be analyzed and looked at and assessed by academics and by investment managers. And it's been proven that it is a fantastic store of wealth. Okay. So when we're investing in the stock market, all we're doing is becoming an owner of those companies. You could in many ways say that you're giving your money to Jeff Bezos and to Tim Cook and to all these great CEOs around the world, and you're saying, I don't want to run a company. Can you run a company for me? And you're owning a slice of their pie. So then every time, you know, if you're an Apple shareholder, every time someone uses Apple Pay or downloads an app, you're making profit as a shareholder. So that's the thing that we would look at doing with clients, is say, right, we need to look at the stock market. We need to own companies.
I see, right. And I've come across what you were saying just there. Another way of saying, in terms of purchasing a little bit of these companies and then having a stake in every single one of the great companies of the world. Another way of explaining it is we're actually owning a little piece of the brain power of these incredible
Mm,
people. We're basically backing them and saying,
yeah.
"You're smart. You know what you're doing. The evidence is right there. I'm
Mm,
backing you to be able to continue doing what you're doing, right?" But of
Yeah.
course, we never go all in, do we? Because then what that means is we've got all our eggs in one basket.
Well, this is it. And I actually was talking to a client the other week about this, and they flipped it back on me and was like, it's like standing on a nail versus lying on a bed of nails, right? If you stand on one nail, if you go out there and buy one company, there's every chance that that nail is going to go right through your foot. But if you diversify and you own all the companies, you've got a bed of nails going on. People walk over and lie on that stuff without any pain. And that's what we're trying to do. And I was like, oh, that's quite a nice little analogy. I'll steal that one.
There
But
we go.
when it comes, there's many sort of rules of thumb and interesting things we can look at in investing. But the only one that is 100% cast iron is diversification, diversification, diversification. We want to spread our money out to reduce risk. So we don't go out and buy one company. We go out and we buy many companies, and different IFAs and different investment managers will have different ideas on what they think a lot of companies is. So some of those, it would be 30 companies. For others, it's 10,000 companies, but we want to diversify.
Okay, yeah. So we go about they go about it in slightly different ways, right? But they're all of the school of thought that it's a good thing to diversify to a greater or lesser
Yes.
degree. Yeah.
Yeah. Yeah.
We can get into that. And you know what? We can probably make a whole flipping podcast about diversification in itself. What we'll do is we'll cover from a high level and how that's done in just a moment. A
Yeah.
lot of people who are listening to this podcast, and maybe this is now where we're catering for the people who are already investing, a lot of people who are listening to this podcast will have been allocated a proportion of their portfolio to bonds, right? Being allocated by their FA to bonds,
Yeah.
right? Where do bonds come into it in your opinion? And by the way, I'm right in saying that it's usually government bonds and not corporate bonds.
It's a bit of both. It really
Oh,
depends. Yeah, it really depends on the financial planner or the investment manager. I'm probably going to use a fair amount of analogies, and I do tend to lean on drinking analogies. So apologies to anyone listening who doesn't drink. Hopefully, they still carry the same meaning. It doesn't lose it. But I would describe bonds as being like the tonic in a gin and tonic.
okay.
Okay, it's the thing that takes the edge off. And this is what we do with bonds in a portfolio, because the problem with equities is that they go up and down. They can be volatile. We have these, I call them moments in markets or temporary declines, where people will see the stock market reducing in value. It's what we're going through right now. You might hear it referred to as a bear market. And so we use government bonds, according to modern portfolio theory. Government bonds will then reduce that volatility because they're not correlated. They don't do the same things at the same time. So they tend to have a lot less up and downs.
I see. So when we're gearing our portfolio more towards smoothing out the volatility, then we can think about allocating a proportion of that to bonds. And there's a variety of reasons why we do that, right? One can be psychological reasons, the other can be because we're now transitioning our assets to the point that we can make cash withdrawals, right?
Yeah. So, I mean, I have this belief that really for most people, we're investors for life with a need for cash flow.
Love that.
So if you think, like if I think back to sort of 2008-9, when I was being trained as a financial advisor, it was you get to 60 or 65, you sell your investments, you buy an annuity, and you retire. And in the last decade, I've arranged one annuity for a client.
Wait, can I just pause there for two
Yeah.
seconds? Annuities were still a thing as recently as that, 2009.
Annuities?
Yeah. Oh, so was it that was just what they taught you in FA school, but in practice people didn't use them?
No, they were still a thing right through till 2014, 2015.
Whoa, I didn't know
Yeah,
that. Whoa,
yeah,
that's really
yeah.
interesting.
So and they're making a bit of a comeback for low risk people. But anyway, the idea, you sort of have this thing of 60 being the end point of our investment journey. But really, you know, if we look at life expectancy of a couple, one of them's going to live to 88, particularly once you're retired. If you're above average wealth, living in above average area, you're going to have above average life expectancy. So you then, you know, you're thinking one of you's going to live to 88, 90, and you're retiring at 60, you've still got a 30-year time horizon. And all you're wanting is cash flow. You're wanting money to, you know, go on holidays and to treat the kids and the grandkids and to replace the car and do the extension and sort this out, sort that. But you're never going to cash it all in at once, not if you've planned properly and done a good job throughout your working life.
There we are, right? So it's all about cash flow, right? And then
It's all about cash flow.
bonds come into it, or at least they can come into it when we want to transition our stocks portfolio to cash flow, to cash.
Yeah, yeah. And the biggest reason why we use bonds at Juniper is to help with behavior. You know, we have clients who are nervous investors. Maybe they've never done this before, or they've sold a business, a practice, and they're suddenly sitting on a lot of money. And it can be very difficult. And I had a meeting just today, actually, with a client who sold his business in January 2020. We invested the money from his business in February 2020. And so you can imagine the journey he's had in that time. We deliberately put a reasonable amount of bonds in his portfolio because we knew if something happened, his life's work, he won't be able to stomach that dropping 30%. There's no way. You know, and then look what happened March 2020. Suddenly everything's falling, and his portfolio dropped, I think, 10%, which he could live with, and then he stuck it through. And we've dialed up the equity content since, because he's now used to this. He trusts the process. He believes in the equities, and they've done this journey before. And I think as financial advisors, you know, it's very easy for us to forget that we've done this. Is our day in, day out. You know, it's the same as a dentist pulling a tooth. It is your day job. But for that person in the chair, they may never have had a filling or a tooth done before. And it's the same for my clients. You know, I've been through this journey a number of times, you know, 2008, 9. Great first year's experience there for a newbie financial advisor. So you get used to it. So we use these bonds to kind of, particularly for nervous clients or for clients who are, you know, new in the journey, we'll use bonds to just even things out a little bit and then dial equities up till the point where they fully trust the process that we're taking them through.
Very, very, very cool. Okay, cool. Thank you for that. So let's move back to equities now. And we use the D word, diversification, and we kind of half explained it. Yeah.
Yeah.
What is it that we need to know in order to diversify our equities portfolio suitably?
Yeah. So if you go back 30, 40 years, the common wisdom was 30 equities, 30 stocks was diversified. Okay. Which is, you know, when we think about that now, it's madness. You know, that 30 stocks is a very concentrated portfolio.
Well, the Dow is 30, and it's all flipping train companies, you know. And some people used to buy the Dow and just say, "There's my retirement fund." But anyway, sorry.
Yeah. Well, this is it.
Yeah.
So now, you know, there are in excess of 20,000 listed companies across the world that we can invest in. Now, some of those are so small that they're not worth buying as retail investors or as in funds. But when we're looking at diversification, the first thing we're looking at is global diversification. The biggest mistakes that I see when it comes to diversification is buying the S&P 500 and thinking you're diversified. Because if you've just got the S&P 500, you've got 20% of your wealth in 4 companies. And yet there are thousands and thousands of companies out there to be invested in. And if you look back a decade at who the top companies were in the S&P 500, they weren't the same companies that they are today. There's one or two of them that are still the same, but a lot of them aren't. Because it's very hard when a company gets very, very big to continue to be the innovator. So you want to diversify. So we diversify. It's the same with the FTSE 100. I've come across clients with, I have a FTSE 100 tracker. That's my diversification. And what you've got really is a very, very small part of the world economy. Here's a question for you. I'm going to put you on the spot here.
Whoa.
Right? If you were to put the global stock markets and allocate them as a percentage, okay, what percent of the world stock market do you think the UK is?
I actually really recently talked about this to someone, and off the top of my head, it's 3%.
Very close. Yeah, that's really good. Yeah. It's just under 4%.
Oh, okay.
Yeah.
And America is something I've seen like 50, right?
Yeah, 60.
60.
60%.
Oh, 60. Whoa.
Yeah.
There
And
we
there was
are.
a point, it's dropped off a bit since, but there was a point where Apple was bigger than the entire UK stock market.
Oh, that is just crazy.
All right. So these numbers, I'll give you a couple of numbers if I can. Yeah. So this is at the end of 2021. Apple was worth 2,154 billion, and the whole UK stock market, not just the FTSE 100, but the FTSE All Share and the AIM market, was worth 2,450 billion.
That's insane. You know, I've got another fun one, which is similar to that. Do you know in the 80s when Japan's stock market peaked out, it was
Yeah.
bigger than America's
Yeah.
really
Yeah.
briefly. And that's a nation of 120 million
Yeah.
versus a nation of, I think it was like 250, 300 at
Mhm.
the time. That's how successful they were
Yeah.
back then. But then they've had this whole stagflation thing. It's kind of petered out. Population decline hasn't helped them. But
Yeah.
anyway, I love little factoids like
This is it. And so the UK used to be about 11% about 15, 20 years ago. And so the UK has been on the decline. So why do we diversify globally and not just the S&P 500 or even the US whole market? It's because you don't know which country is going to come through and which currency is going to outperform over time. You know, there's all sorts of theories out there about the changing political order. If you're a Ray Dalio reader or any of these sort of things, you know, we've got the rise of China or, you know, India and the BRIC countries. We've got the EU, you know, we don't know. There's no predicting it. But so we need to diversify across all of these countries to make sure that we're in with a chance over our 30, 40, 50-year time horizon of protecting the value of our money and being in the great companies of the world. So we diversify.
lovely. So that's why we do it. And then I know we got to be a little wary about this, yeah, given that we don't want to contravene any rules about financial advice or anything. Let's take it one step further as much as we can. How would we do that? How does that actually translate to the actions that we'd undertake?
Okay, yeah. So we'll talk in theory and try and avoid any. Oh, press the button. So I've got a stand-up desk and I'll press the button by accident.
All
That's
good.
why my camera's moving and people are watching this on the camera. Oh dear, we can cut that bit out if you want. You know, so we won't mention any funds or anything like that. But in essence, there's 3 ways that we can go out and invest in the stock market. We can go out and buy companies directly ourselves, okay? And we can try and decide for ourselves which companies are going to outperform or which ones we believe in. Achieving diversification will be very, very hard if you do that because you're going to be buying such tiny fragments of some of these companies that you just won't have the scale. So you end up with quite a concentrated portfolio, which will either do really well because you got lucky and picked some good companies, or really badly because you got unlucky and picked some really bad companies. It can also be complicated trying to buy in foreign markets, depending on the platforms you're using. You can go out and buy an active fund, where we're essentially paying a fund manager to make those stock picking decisions for us. Some of those will buy a specialism in a specific market, so that you can go out and buy a FTSE 100 active fund, and they will just play in the FTSE 100 and try and outperform. Or some of them have global remits, where they will try and pick, from the global market. And you're then reliant very much on that fund manager's skill, which is, there's various studies that have shown most of them don't have a lot of skill. There's a few, maybe less than 1%, who do. You've got to pick the right ones. You've got to back the right horse on the active fund game, but some people do enjoy that side of it. Or you can go out and you can buy an index fund. Sometimes these are called passives. And with an index fund, you are buying a basket of investments within whatever the remit of that index fund is. And sometimes you can look at, say, ETFs as well, or another type of index fund or passive instrument. What you've got to be wary of with an index fund is, just because it's an index fund doesn't mean that it's going to be diversified, because you can get really niche index funds. You can get the ones that only invest in companies that are in automation. And you might have an index fund with like 15 companies in it, etc. So just because it's an index fund, you've got to look at what is that index fund and what's it going to do within my portfolio.
Boom. There we go. Yeah. Lovely hot take on that. I wanted to chuck something in on top as well.
Yeah, sure.
Whenever it comes to this whole active versus passive thing, right? Yeah. So you've got the people who are just like, okay, I just want somewhere to store my wealth. Okay. And because that's basically what investing is. It's just a better place to store it, right? Is another way of thinking about it, right? And I get that philosophy where you buy an index which has like flipping 60 years of history to say that it's appreciated, okay, which that history is on your side at the very least. Doesn't mean that it's a guarantee it's going to continue. Of course, you have to get that little disclaimer in there, but at least you've got a huge amount of history on your side, and you're also literally using the methods that an FA would probably use anyway. You've just educated yourself in it, right? So you've got that weight behind you, let's say that. So you've got that philosophy, and then you've got the people who fancy it a little bit, and they're like, well, I'm going to go buy this company and see how it does, or I read this thing that says that Apple's going to have a good year, so I'm going to buy Apple and blah, 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 and all this stuff, right? So with that whole philosophy, right, and take this from someone who's been there and done it a million times, right, way back in the day, and now does it purely passively, okay? And the reason for that is, what I always noticed is, you'll do well, you might even do well for a start. You're either, one of two things will happen, right? It'll go really well, or it won't go so well, and you'll be like, screw this, I'm just going to go passive, right? But when it goes well, right, the whole psychological phenomenon you have to work against is where you think you're hot shit, basically, okay, and you're like, yeah, I beat the market, yeah, I've been investing for 2 months and I'm beat the market, right? It goes well, okay, but then when it doesn't go so well, because you're not, to consistently beat it is very, 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 very difficult. Like, if professional fund managers can't do it, the amateur, the beginner, has little hope, right? So let's say it does outpace at the start, and then it after that point where it starts to not do so well, that is actually tougher than when it does do well by an absolute mile, right? Because then you start to think to yourself, Jesus, what am I doing? Have I got in over my head here? What do I do next, right? And the whole turmoil that you put yourself through in that scenario consumes so much brain space, right? So many times, that the eventual conclusion that it led to for me, where I was just like, you know what, I'm just going to go passive, just buy a fund that reflects an index that has 50 years of history. Then I know that there's a huge amount of history on my side, and whether it goes up or down, I know that the trend is upwards. The trend is your friend. So the bend at the end is the last bit, and it goes from bottom left to top right. And for me, I was like, all of a sudden, I was getting consistent rates of appreciation over many years, of course, consistent because it's a long game,
Yeah.
consistent rates of appreciation that consumed exponentially less headspace. And I was like, right, this is for me.
So this is it. Like our investment philosophy at Juniper, we've got an awful lot of research that's gone into why we invest the way we invest, including like a document that runs to about 8,000 words that details our investment philosophy. Because for us, when we put something in our client portfolio, we really need to know the rationale of why that's there. Because then when the market changes or when the world does something you weren't expecting, you've got to ask yourself, was the rationale right? Is our rationale still right? And what did I base those decisions on? Was it a good decision? And it's the same when you're doing this DIY. You have to know, what is the reason you picked this company or this fund? What did you believe about them that made them deserve a place in your portfolio? And I'd almost encourage people to write it down, even if it's a couple of bullet points. I bought this company because I believe X, Y, and Z. And then when you doubt yourself in a few months or few years, go back and ask yourself how often you got it right. And the other thing that they'd even do is just sit down and play the game of up or down. Just for a week, 2 weeks, is the general stock market, pick an index, S&P 500, FTSE 100, and just play the up and down game. Is it going to go up? Is it going to go down? It doesn't take very long for you to realize that you don't know. These short-term games are so difficult. There's a thought experiment called a random walk down Wall Street, where a guy flipped a coin like 500 times and recorded the results and put it into a statistical chart and showed it to a load of fund managers, and he, like, as though it was a company, and asked them to predict what was going to happen to the company next. Yeah, it was just a flip of a coin. There was no actual statistical reasoning behind it. There was no evidence. It was just, this is what it looked like historically.
There
I
we
think that's
are.
it. Yeah.
Interesting stuff. No, it really is so seemingly spontaneous in the short term, seemingly sporadic, and that is basically what you're up against when you're picking stocks. And you know what? I'm sure there'll be some people out there who can do it successfully. But here's my logic, right? If you're gonna learn how to run, you got to learn how to walk first, at the very least, which is the
Yeah.
more
And I think when people think about the people who have done it successfully, people like Warren Buffett are often their go-tos, right? But here's the thing that Warren Buffett has that you and I don't. When he believes in a company, he doesn't invest in it, he buys it. He's the third biggest shareholder in Apple. So if he has an idea about what Apple should be doing, or some sort of issue with the way Tim Cook's running the business, he picks up the phone, he takes Tim Cook for dinner, and Tim Cook has to listen. Right? The other two investors who are bigger than him is Vanguard and BlackRock. Right? So
that
when
is
Warren,
interesting.
that's, and between them, they own about 15% of Apple. Vanguard, BlackRock, and Berkshire Hathaway. So when Warren Buffett is outperforming the market over a number of years, yeah, he's got time on his side, he's got incredible discipline, and he's got the ability to make impacts in that company that other mortals don't.
There we go. Incidentally, I'm reading his book at the minute, The University of Berkshire Hathaway.
Okay, cool.
Yeah, I've got a few books. I'm spinning a few plates when it comes to books at the minute, but that's one of them.
Yeah.
And I've just it's like a chronology of all the AGMs, okay, for
Yeah.
Berkshire Hathaway, right? And it's like chapter one is 19, I don't know, 70, something like that. And then each chapter corresponds to a year. So I'm in the year 1991 at the minute, right? And he's just bought Coca-Cola. Okay, so
Yeah.
we're gonna see how
Yeah.
that transpires. I don't think he's invested in Apple yet, but I'll keep everybody posted on that
Yeah.
one.
So here's the
Anyway,
thing. In the short term, very, very hard to know what's going to happen, right? But in the long term, humanity and capitalism has this ability to innovate and generate value. And that's all the stock market is doing, is capturing the value that humanity creates. Okay. So when they invent the iPod, or when they invent Coca-Cola, or when they invent OpenAI and ChatGPT, eventually these things are all captured by companies because we love using their products and services. And as shareholders, we capture the value. So the stock market will have these temporary declines, but it goes up way more than it goes down. And so over time, it's where we want to be. But don't try and predict it in the short term.
Boom. Thank you for that, John. And you know what? What a nice note to end the podcast on. We're coming up to the 40 minutes mark-ish. If anybody wants to know more, where can they find yourself, John?
Well, you can find us at juniperwealth.co.uk. We have Juniper Wealth UK on Instagram. I'm Juniper John on Instagram, and there'll be lots of ways. You'll find me hanging around the Facebook group. There is so much more that we could go into. Like there's days of stuff. So hopefully we'll do another one of these and take this deeper.
We will 100%. I need to do more tangible investing podcasts because I know that we kind of bounce around between being profitable in business and all that stuff, and I want to move the podcast back to the essence, the reasons why we created it initially. So yeah, watch this space, everybody. Let's do one on, I think diversification will be a good one, right? Or even building on what we did today.
Yeah, there is like so much we could go into that, and on asset allocation, which is the fundamental part of diversification. So maybe that's our next one.
That's the next one right there. Boom. John, thank you so much for your time, mate. We'll catch up really soon.
Absolute pleasure.